Okay, let me know if I missed somebody here. So far, I have Mariah Fisher missing. I have David Ford missing. I have Jelene Jones missing. And I have Eric Loveberry missing. Everybody else is here. Okay, does anybody have any issues that they want to discuss? Any problems with the class? Any content they want to go over again? Yes, Amber, what is it?
Last night I had trouble when we did the brief exercise of 3.2. I did not understand of like how to set it up. I think I understood a little bit of the material, but I didn't understand like
Okay,
how they wanted us to set up the comprehensive statement. I believe.
exercise 3, right?
It's
One we went over in class, didn't we?
did we go over it in class?
All right, which one were you looking at that you had trouble with?
Brief exercise 3.2.
3.2. Okay, 3.2 wasn't assigned.
Lecture
I
B.
think she means 13.2.
Oh yeah. Ooh, I was blanking out.
Um, I have that I only signed 1, 4, and 5.
It's I think it's homework assignment 5, I believe.
You are right. Okay. All right, do you see the solution on your page? You guys see the solution?
Yes.
Okay, I just want to make sure you can see what I'm seeing. Okay, so it says so what they want you to do is break out the parts. So income before income taxes is 450,000. So that's the part that is the sustainable income, the normal income that the investor, the decision maker, the investor is going to want to use and expect the company to make. These other items are the what I call noise. So the income tax expense is the noise, is the amount of income tax they're gonna be paying on the 25%, on the 450. So what you do is you come down to net income. Net income would be the number that, in this case, net income would be the number that, you use to make your estimate, the investor would use to make their estimate. So the company made $450,000 in income, meaning their revenues exceeded their expenses by $450,000. They have to pay tax on that, 25%. So they're really, the investor really comes out with $337,005. Is that okay so far?
Yes, so for the income before income taxes and the income tax expense. So for my bad. For the income tax
Multiply
expense,
the income by the tax rate.
yes, and then for the income before income taxes and the income tax expense, so it's 450,000 and the other number, and then you just subtract them to get the net income.
Right, you subtract the 112.5 from the 450 to get the 337.
Okay.
Okay, and that would be the information that you'd expect the investor to use to make decisions about whether he or she wants to invest in the company. The other stuff is the noise stuff. So, as we said, they had an unrealized gain on available for sale. Now, that is something that's more related to what an accountant does. Let me give you a little bit of a breakdown of what that is. So every year, I have to adjust the value of some of my securities. So let's say I invest in company X on January 1st, 2020. And I buy 100,000 shares at $1 a piece. So the value on my balance sheet of that investment is $100,000. So under my assets, I show an investment in ABC Corporation of $100,000. Now, at the end of the year, December 31st, when I issue the new financial statement on December 31st, 2020, let's say those 100,000 shares are now worth $3 per share. $300,000. I get to recognize that increase because the value of my shares went up. But it's an unrealized gain because I never sold the shares. I'm still holding those 100,000 shares. The shares went up. And that's actually a perfect example of what the noise that they're talking about. Okay, I'll answer you in a second, Susanna. Let me just finish this little lecture here. So this is what they would call a book gain or a gain that has no bearing on the investor whatsoever, because the investor didn't get any part of that $200,000 increase. And we don't get any part of it until we sell it. So if we sold those 100,000 shares, then yes, we would have a gain, and the investor would be able to take part of that gain in his decision. So instead of the 450,000, let's say the 200,000 was a gain, our income would be 650,000, and the owner and the investors will be able to use that. But since we never sold the shares, the investor doesn't benefit. So therefore, it's noise or other comprehensive income. Does that make any sense? Anybody? Does it make sense? Any kind of sense?
Like, kind of. I think a lot of us were confused because so for the unrealized gain unavailable for sale securities net of, I have no idea. Why would you say net of 17,500?
Okay, that's a good question. Do you understand what what the FASB's trying to do? They're trying to give they're trying to give the information that an investor can use, the sustainable information that the investors can use in order to make a decision. And they're separating the information into stuff that's going to be reoccurring and stuff that's expected not to reoccur. That's the first step. And the reason this 200,000 is not, that in my examples, 200,000 is not something they can use is because they haven't got any gain yet from it. It doesn't happen all the time. So it's in other comprehensive income. They just used a real bad example of how to do that. Now, the net realized gain. So on the income statement, you have to show the net. So they sold it for 70,000, but they paid 17,000 in taxes. So the net benefit to the company was 52.5. That's where that net of comes from. So they sold it for 70, but they had to pay tax on that income, just like anybody else has to pay tax on a gain in sales. And that tax amounted to 17,005. So they netted the difference between 70,000 and 17.5 is the 52.5. So the company netted 52.5. Is that okay?
Yeah, that makes sense.
Okay. What I'm trying to get out of this is the idea of separating the types of income into two categories. One that will reoccur that is expected to reoccur every year, and one that is not. That's in essence what the FASB is trying to do. Now, Ken, you're going to get involved in all this in immediate one. But the rest of you probably will never see this. I mean, as you'll see the type of income, but you'll never have to prepare this section. Problem that I wanted to use came with that answer. So, does everybody understand?
Yes. At least I'm speaking on my part. I understand.
How about everybody else? And do you understand what I want you to take out of this is the FASB is in its own weird way trying to separate the two types of information that the investor is going to use. They consider this to be the easy way of showing it. Now, you have your opinion whether or not it's the best or not.
So for the comprehensive income for 390,000, I believe we were provided that, correct?
No, you would have to calculate that.
How did we get the comprehensive income? Did we?
All right,
Just
so the
net.
450 minus the tax is the 337.5. Then if you add the 52.5 to that, you get the 390.
Oh, okay.
Again, the important thing that I want you to know about this is that this is the FASB's way of showing investors or users of the financial statement the different types of income they would use to make their decision. So the investor is expected to make his or her investment decision based on the 337.5, whether or not he or she wants to invest in the company, whether he or she wants to invest more in the company, whether he or she wants to sell his or her shares, should be based on 337.5. And the 52.5 is the noise that we talked about in the other class. I have a question from Susan. Yes, Suzanne, I would just submit 13.2. I'm not sure what you mean by resubmit it.
Hey, I have a question.
Okay.
My volume kind of went out a little bit, so I don't know if anybody just asked this. But what's the amount of points that we would get for submitting it the next day?
I haven't set that up yet, but it'll be 90, 95. So the total, so if you, so the total, every assignment is worth $100, $100, 100 points. And that's just the way I have to set it up for Canvas in order to do the way I want to do it. So if you submit it within 3 days, it'll be worth like 90 points. And then 6
Okay.
days will be 80, 9 days will be 70, blah, 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 blah. And it
All right,
won't go
thank you.
lower than 40. Does that make sense?
Yes, sir.
Okay. So Amber, are you okay with everything?
Yes, I'm good with it.
Sure?
Um,
Go ahead.
yeah, I'm good with that one. I also have one more question.
Okay.
I'm trying to figure out which one it was real quick. It was the question where we only did 1 and 2. I can't remember which one it is. My Wi-Fi is being slow.
I think that would be 1B.
Yes, that one. For number 1, I I could explain sustainable income, but the second part for how does it connect for discontinued operations, I didn't understand it.
Okay. I didn't give you the answer. All right, I need to upload the answers to that. Okay, the connection would be so sustainable income is simply the income that I would expect year to year that's going to happen in the future. That's fairly easy concept.
The screen's black on ours.
Yeah, I'm opening up something. Okay, so sustainable income is defined as the most likely level of income to be obtained in the future. Meaning simply that it's what we want the investors to use, the information we want the investor to use, which is kind of the most important thing. But it just refers to what we expect in the future without the noise type of items. Talking about. It is the amount of regular income that a company can, I hate the term regular, but that a company can expect to earn from its normal operations. In order to distinguish between the company's net income from sustainable and irregular items, FASB requires this thing called discontinued operations. So the relationship between sustainable income is, and discontinued operation is, that sustainable income is different than what he calls regular income. The reasoning for the separation is because, again, the FASB wants you to use the information that is reasonably expected to happen. So what they're doing is they're separating it. And that's what the relationship is. It's separate. It's in addition to, or it's subtraction from. But the relationship is that it's separate. Does that make sense?
So you wanted us to understand that sustainable income and income relationship is separate?
Sustainable income is different. Is a different category of income than discontinued operations. The relationship is that they're separate. They're two separate bits of information. Does that make sense?
Yes.
And do you see why I'm saying that?
I never understood what discontinued operations was actually.
Okay, so an example of that, let me see if I can do it in an example. So a company is operating, let's say we have a company and it's operating a division, 3 divisions. A division is simply a small part of a corporation. Okay, so this company, this big company, let's say it's Amazon. And Amazon operates its mail delivery service, its product delivery service, and its business product delivery service. So those 3 divisions operate as one under the umbrella of Amazon. So far, okay?
Yes.
Okay, so what they wanted, so let's say the business product delivery is not profitable and they want to discontinue that. So they're going to completely drop that division and only operate the mail division and the product delivery division. Okay?
Okay.
That's what it means. I'm discontinuing that operation. Now, what I was saying was the reason that's a special type of income is it doesn't happen every day. Because number one, once they discontinue the business product delivery division, they're not going to be able to discontinue it again. They can only discontinue it once. And hopefully they're not going to be discontinuing operations every year. So discontinued operation is just that. I don't want to continue running that business for whatever reason. And the reason it's separate is because it doesn't happen all the time. Don't expect it to happen all the time. Does that make sense?
So like discontinued operations is not continuing service of a company.
Right. I'm not going to continue that business anymore. For those who don't understand where I got the 52.5, it's the 70,000 gain on sale of in problem 2 BE 13.2. It's the 70,000 times 25% the tax that I'm gonna pay on it. So take the 70,000, multiply that by 25% and subtract that number from the 70,000, and you get the 52.5. Anything else? Anybody have any other issues? All right, so can anybody see what the slides are on the screen? Concept of sustainable income, important because blah, blah, blah.
Yes.
This is all review that we did last time. And we covered discontinued operations. We covered accounting changes. Quality of earnings, channel stuffing. Okay, so we stopped off at the analysis part. So what we do as managers and as business decision makers, we use what's called horizontal and vertical analysis, which is really just ratios. So we're going to learn that next. Investors are interested in core sustainable income of the company, which we talked about, making comparisons from period to period, and three types of comparisons: intercompany, intercompany, and industry averages. So intra-company are those between the company that year to year. Inter is how they did against their competitors, and industry averages is how the company did against all the companies in their industry. So what we're going to be doing next is just analyzing the financial records of this company. And we do that with ratios. The ratio is simply the percentage change from one year to another or from one company to another. Okay, so how do we do that? Well, the book on page gives you this example on page 1311 of your textbook if you want to look at it. So what they're doing is they're taking different parts of the balance sheet that we learned in 260 and trying to get an idea of what the change was. So for example, this little chart shows that current assets, the total value of current assets were 2,717,000 in 2022 and 2,427,000 in 2021. In 2021, I'm talking about these numbers right here. So there's two ways you can perform this analysis. The first way is just subtracting one from the other. So if you subtract 2717 from 2427, you get 290,000. So that tells you that current assets increased from 2021 to 2022 by $290,000. That should be pretty simple, right? The amount of property assets, property, plant, and equipment increased was 2,816,000 or 2816. And at the end of 2022, it was 2,990. So if you take the difference there, it's 174. So the amount of property assets increased by 174. Other assets increased by 219. So the same thing. You take these 5690 and subtract the 5471 and you get the 219. So the math part of this is fairly easy. And you do that with whatever you're analyzing. Boss, do it exercise number 2. There it is. Okay, so on page 1314, I'm looking at do it exercise number 2. So what we would do, the first step would be to subtract 234,000 from 180,000, and we get $54,000 as an increase. So all I did was take the 234, subtract 180 from it, and that gave me the so the 234 minus the 180 gave me the 54, the amount. 756 minus the 420 gave me the 336. And then the 990 minus the 600 gave me the 390. That's just math. That should be pretty easy. The next part is the percentage increase. You also want to see how much as a percentage it increased and decreased. The first year of your analysis is always going to be the base. Please write that down.
Can you repeat that real quick?
Sure. The first year of your analysis is always going to be the base. Everybody get that? So in this case, 2021 is going to be your base year. And I'm going to give you a formula in a couple minutes. So 2021 being the first year will be your base year. You're always going to subtract the current year from the base year that you're analyzing from the base year. So the current year is 2022. And the current assets in the current year is 234,000. So you simply subtract the 234,000 by the 180 and get 54,000 and divide by the base year. You always divide by the base year. Write that down, please. Always divide by the base year. So the current year minus the base year divided by the base year.
Dr. Seaman, how do you get the percentages?
That's what I'm typing.
Oh.
So that leaves you 54,000. And if you divide 54,000 by the 180, you're gonna get a percentage. You're gonna get 30%. Okay, everybody try the plant assets or plain assets. I think that means plant. See if you can get the 80%. Is anybody having trouble getting the 80%?
I just don't understand how you got it. I'm just struggling understanding it.
Okay. Okay, Ken, let me answer Amber's question first. Okay, what don't you understand?
So you're taking the current year minus the base year divided by the base year.
Right, so put it in your calculator. 234 minus 180 equals 54. Hit the divide sign. Put in 180. That should give you 30%.
What sign did you say I put?
Okay, 234, put 234 in your calculator.
Yeah.
Minus the base year, 180. That gives you 54,000. So
Yes. And then that's
go ahead
when
and divide. Put in 180,000. That should give you the 30%.
that's the
Right,
so
that's the answer.
percent.
30%. So do the same thing with plain or plan assets, depending on, mine is written plain, but it should be plan. Try to get that 80% figure. Kristen, are you okay?
Yes, I am. Thank you.
Sorry, I pronounced your name wrong. How about, Kenneth, are you okay?
Also, I want to add this. So you see the $420,000, right? Where it says December 31st, 2021.
Mm-hmm.
So under point assets, can you do $420,000 times 80% to get to $336,000 as well?
336,000 is not the answer, though.
Like when it comes to like the increase in
Oh,
2022.
yeah. I'm sorry. My mind is focused on. Yeah. This is just the simple, I'm just showing you the simple math so that everybody. I didn't, sorry about that. I wasn't concentrating on. Did everybody get the 80%? awesome. So that just means that current assets increased 30% between December 31st, 2021 and December 31st, 2022. And plant assets increased by 80% between December 31st, 2021 and December 31st, 2022. We're going to get into what that means next class because I'm already up again. So I'm going to end it there. And we'll continue this next class.